Welcome back to Drill Down Earnings. I'm Cory Johnson, Chief Market Strategist for Epistrophy Capital Research. The latest results from Texas Instruments, one of the 50 most important companies in technology. I think it's really important because it's one of the largest semiconductor makers, sometimes the largest in the United States, but very different than a lot of the companies we talk about in semis these days when we're talking about NVIDIA and AMD and so on. Q3 earnings for this number, Wall Street just likes beat or misses. They like the beats, they don't like the misses, at least most of Wall Street. This was better than Wall Street's expectations. $4.64 billion was the expectation. They got $4.74 billion. They wanted $1.48 in earnings per share. They got $1.48 in earnings per share. So why is this stock down? What's the problem, Wall Street? Well, this goes beyond a miss or a beat. I think that there was a miss when you look at the future projections of what earnings per share might be. When we look at the numbers, I'm going to show you why I think these numbers are pretty good here. So I mentioned a $4.74 billion in revenues, or you can look at the profits of $1.36 billion. Cash flow from operations of $6.9 billion, $2.4 billion in free cash flow. But look, revenue growth is back at 14% on a year-over-year basis for this company. This business was shrinking just a year ago, and for quite a while in the post-pandemic period, we're doing right now quite well indeed. And margins are getting kind of better, 35% operating margins for this company. It's stabilizing in the midst of a fab transition. Fabs, the fabrication facilities, the factories that make semiconductors. These guys own their own factories. Jerry Sanders said once upon a time, real men own fabs. Jerry Sanders was the CEO of AMD. He's no longer the CEO of AMD because a lot of companies figure out it was smart to not own some fabs. But Texas Instruments doing just fine, thank you very much, with their fabs and transitioning to better and more modern fabs, specifically closing their final 6-inch fabs in Sherman, Texas, which is just north of Dallas, Texas, where they have another one that they're closing. And as a result, they incurred $85 million in charges, which weighed upon the results in this quarter. Otherwise, it would have had more profits in the quarter, indeed. Our production is now going to consolidate around 300 millimeter wafers going through into the first half of next year, but that's going to raise depreciation costs into next year. That's why the guidance maybe wasn't what some might have hoped for this company, why the stock was selling. Nonetheless, kind of across the board, showing an improvement. The big business for them, analog, 79% of revenues in the quarter. That was strong. Embedded 15% and 6% of the revenues was their other category. But look, analog growing really strong, again, as I mentioned, at 16%, but embedded up 9%. Their other business up 11%. And that was pretty strong for these guys because to see the embedded business, although smaller, join the party with analog, look, it's really good news for Texas Instruments, showing signs of life across all of their product categories in ways that they had not in recent quarters into the last few years. They don't give us a breakdown that they used to of the different types of businesses. They used to give us very specific numbers about industrial, automotive, and so on. Now they just give us percentage changes. For a model geek like me, that's not so helpful. But industrial up 25%. Automotive, they said high single-digit growth, which maybe bucks a trend from weak automotive results we've seen in the last few years. And also, I mentioned their enterprise and communications business. We don't know how big those businesses are, but growing 35% and 45% for each of those. So we talked about how the stock market did, and I want to get to that. So the stock market did not like these results, did not like the guidance. The stock was down 8% in after-hours trading. That matched the loss of the entire last 12 months, also down 8%. So not great for Texas Instruments shareholders. But one wonders if the results are kind of strong and the focus on, the cost of CapEx changes and depreciation trajectories maybe weighing on earnings per share. When the market has a chance to look through these results a little closer, I think they might see what we see, you and me. We see the changes there being kind of good for this company. This is another thing they didn't talk about a lot, but boy, inventory improving, 223 days of inventory. That is an improvement for this business with some discipline, holding it flat at $4.8 billion, even as revenue is rising for this company. That was a point of focus, at least something that jumped out at me in the conference call. Here's CEO Haviv Ilan.
We're very pleased with our inventory levels. They're doing what they're supposed to. So now we are moderating those wafer starts, those load-ins, and as those comes down, we get the impact on gross margins. Let me just also step back and stress that we run the company with the mindset of a long-term owner and the objective to grow free cash flow per share over the long term. And that is gaining momentum. On a trailing 12-month basis, our free cash flow is up 65% from last year, and it has the potential to accelerate and grow even faster next year, as we have outlined in our framework back in the capital management.
So focus on inventory, which of course is the thing that always screws up these chips companies. It is when you see the problems that come in inventory, there's another problem coming. Inventory for these guys seems to be getting better, and that lets them focus on free cash flow, which is the measure of all good things in business. So why not? But what's the one number that tells us a whole lot? Your drill down earnings takeaway. I've got that in just a second. But first, take a moment, follow us here on YouTube or on Spotify or on iTunes, wherever you're listening to this or watching this online. It really helps us with our numbers and understand who's watching us and what you like so we can keep giving you more of it. But your Texas Instruments Q3 drill down earnings takeaway, your key numbers here, $4.74 billion in revenue was strong. It was a really good increase because revenue growth is back for this company at 14% on a year-over-year basis after many years of declines in the post-COVID period. But I promise you the drill down earnings bite, the one number that tells us a whole lot, and it is $3.729 billion. That was the revenue in their giant analog business for Texas Instruments. They're shifting to better fabs. They're going to update a lot of their technologies, but in the process, they've got their analog group business growing quite well at double digits to $3.729 billion. All right, thanks for checking out Drill Down Earnings. Follow me on X at Cory TV, and of course on TikTok, Instagram, or on YouTube at Drill Down Pod.